Would you like to learn an option spread that gives you a 70% or greater probability of winning as soon as you put the trade on? Hi, I'm Larry Gaines, Power Cycle Trading, and in this video I'm going to show you how to use a bear call credit spread, which is basically selling option premium, and to set up a short trade. So you'll see here this is Chipotle Mexican Grill. And first, looking at the trade setup, you can see that this particular stock, Chipotle, has really started to roll over. So it broke this trend line, and this was back on the 5th, and then yesterday opened up below the trend line and sold down, all the way into the close. So based on this just kind of a trading pattern and a breakdown, a couple different ways you can trade this. You could just sell the stock short, you could buy puts for a downside move, or you can sell an out-of-the-money, what we call bear call credit spread. So you're actually collecting premium. Now, the reason that you would sell out of the money is because you can get a very high probability that it will close below your short strike. So in this trade setup, we set it up to sell the 492.5 call, buy the 497.5 call, and that was done right here yesterday on the 6th. So you can see how far out of the money that was. Now that was about 1 standard deviation, and that's a statistical measurement that tells you that it's basically you're starting this trade out with almost an 80% probability that this price 492.5 would be out of the money by expiration based on your option series. So let's take a look at the option chain. So here's the option chain of Chipotle, and the setup was based on the June monthly option series, which has 9 days to expiration, or 10 days yesterday. So if you look here at the 492.5 strike right here, and you come over to delta, you can see that today that option delta is 8. So that's basically telling you probability out of the money today is 92.88% probability that by next Friday, not this Friday but next week, this 492.5 strike that was sold would be out of the money. Okay, so only an 8% probability that it could be at 492.5 statistically. All right, so yesterday when this was set up, it was about 17, a delta of 17, which would be about an 83% probability, and that's close to over 1 standard deviation out of the money on that selling that credit spread. So it was selling the 492.5, buying the 497.5 as a spread, and that was set up. Selling it, collecting $50 credit. Now you'd say, well, why would you do it for just $50? Well, because going into this trade, you've got almost an 80% or greater probability that this will close outside this 492.5 short strike will be way out of the money, and the price will close below it. You can see it's currently trading at 463, and today that's only has an 8 delta, so there's only about a 90%, 93% probability. So that's the reasoning and the beauty of credit spreads, and they're very easy to defend. So all I would do here, if it started to go back up, I could buy a debit spread against it to convert it to a butterfly, and I would have this structure here. Whoops, hold on once. So if I wanted to reduce my downside risk, I could easily convert this to a butterfly by buying a vertical call debit spread right here, 487.5, 492. Neutralize that risk down to $25. Hope this helps. Talk to you on the next video update.